Hi, we're going to work problem 7-2B, estimating and reporting bad debts. At December 31st, Ingleton Company reports the following results for its calendar year. So it gives us cash sales and it gives us credit sales. Now keep in mind that cash sales have already been received. In addition, its unadjusted trial balance includes the following items: accounts receivable, $575,000 debit balance, allowance for doubtful accounts, $7,500 credit balance. So we are to prepare the adjusting journal entries to record bad debts under each separate assumption. So keep in mind that we have been recording accounts receivable and sales throughout the year. And now we're looking at our accounts receivable balance at the end of the period, either the end of the month or the end of the year, to determine if any of those receivables we feel are not going to be received. They're going to be bad. So we're going to be looking at our allowance for doubtful accounts. That's the allowance set up for the amount that we think will not be collected, to see if we need to make some adjustments to it. So there's different methods to do that. One is going to be a percent of sales. The first ones we're going to look at, A and B, are using this method. These are the easiest to calculate. You're simply going to take the sales that it defines times the percent, and that's going to be your journal entry. So we're going to do these first two. So bad debts are estimated to be 2.5% of credit sales. So you're simply going to take your credit sales, 1,342,000, times 2.5% or 0.025, and that's going to give us 33,550. So I have below here the actual solutions. The journal entry to record bad debt expense, it's always going to be these accounts. We're going to debit bad debt expense and we're going to credit the allowance for doubtful accounts. In B, very similar. Bad debts are estimated to be 1.5% of total sales. So we're going to add up the cash sales plus the credit sales to determine total sales. Then we're going to multiply that amount times 1.5%. So here we have that times 0.015 or 1.5%. The amount's going to be 35,505. Again, we're going to debit bad debt expense. We're going to credit the allowance for doubtful accounts. So no, we do not credit the accounts receivable. We keep the accounts receivable on the books. Whoever it is, they still owe us. We're just allowing that we expect some to be uncollected. So those two examples are showing the percent of sales. So again, you're just going to do the calculation. You're going to make the journal entry. Now, when you are working with the accounts receivable balance versus the sales balance, we're going to calculate it a little bit differently. So in this example right here, an aging analysis, so that's an aging of our accounts receivable. They're put into columns based on when they are due or how far past due they are. The aging analysis estimates that 6% of year-end accounts receivable are uncollectible. So we're going to take our accounts receivable balance, $575,000. We're going to multiply that times 6%. Right here, and we're going to get 34,500. Now this is telling us the amount that we want the allowance to be after we make the journal entry. So once we've determined this amount, then we're going to subtract any amount that's already in our allowance account, which is $7,500 as given above. So that gives us a $27,000 credit that we need to make for the adjusting journal entry. So again, the accounts are the same. We're going to debit bad debt expense and credit allowance for doubtful accounts. However, we are going to take into account any amount already recorded. Now, if we wanted to show that on the balance sheet, it would be in the current assets section. We would have the accounts receivable balance. We would subtract the allowance for doubtful accounts after the adjusting journal entry. And it's going to give us this number. This would be for the first example that we looked at above. So to define each one, accounts receivable is the total that is owed to us. The allowance for doubtful accounts is the amount that we expect to not be collected. And that gives us this amount when we subtract them. That's the amount that we expect to be collected, or we call that the net realizable value. The next questions we're going to look at dealing with notes receivable. So quick study 711. On August 2nd, June Company receives a $6,000 90-day 12% note from customer Ryan Albany as payment on his $6,000 accounts receivable. So Ryan already owes us $6,000. However, he has asked for 90 more days to pay. He's agreed to pay 12% interest on that amount. So first we're asked to compute the maturity date. So it's going to be 90 days from August 2nd. And then to prepare the journal entry to record the receipt of the note receivable. So it's just a matter of counting days. So August has 31. The note starts on August 2nd. So there are 29 days remaining in August. We add to that the 30 days in September. And then we need 31 more days to equal the 90 for the total for the note. So this note would be due October 31st. The journal entry, we are increasing the note receivable for $6,000 and we're decreasing the accounts receivable. So basically it's just a transfer from the accounts receivable to the note receivable. And then the next question is on October 31st, what would the journal entry be? So we know we're going to be receiving cash. It's going to be the amount of the note receivable of $6,000 plus interest. We're going to be crediting the note receivable because it's now going to be satisfied, the $6,000. And then we're going to credit interest revenue. The interest revenue is calculated principal, which is $6,000, times the rate of 12%. Now don't forget to include the time. If you do that, that would be for a full year. Times time. The easiest way to do this is the number of days divided by 360. So times 90 divided by 360 gives us $180.